Hi everyone, I'm Damien.
And I'm Jeremy.
Welcome to our Suburb Data podcast, where we cover everything from property investing to expert busting. If you're new here, we share our personal and professional experiences from 23 years in the game, so you skip the mistakes we made and go straight to property investment success. And today, Jez, we're going to be discussing vacant land or risks when investing near.
Yes, this one, you may have heard me say, supply is the enemy of capital growth. Well, vacant land is the potential for that supply.
And before we jump into this, we do have visual aids. So you have created a presentation. So
yeah, fair few charts.
Yeah, so YouTube, Apple Podcast or Spotify, you can watch it visually also. So I highly recommend. I'll do my best to sort of step everything through, but it is quite detailed.
Yeah, and we have a couple of special guests later on.
That we will introduce.
Yeah,
all right.
Excited about that.
Well, how about we jump into it?
All right, so if you want to show the first slide. So the satellite imagery on the left shows a typical new development. They're called Greenfield estates, may have looked green before, but during development they look brown since all the trees have been chopped down. Now, once these supply corridors start, they can take many years to fill out. It might take decades even for the area to eventually look like the image on the right. And the area of the image on the right is where investors should be focusing their buying attention. So this is a well-established suburb, very little vacant land, and therefore very little opportunity for supply to thwart growth. Now, this seems like an obvious choice, avoid vacant land, but you would be amazed at the number of investors who get lured into places like the examples on the left. And it's usually that sort of brochure, shiny brochure you get from a developer. And it certainly doesn't help having professionals in the industry pump up such locations, and they could be incentivised by commissions. In fact, there are quite a few developers, or some developers, who disguise themselves as investment advisors to more easily fool investors. And they make themselves look like they're on our side, on the investor's side, but they are our enemy.
Well, they're really looking after their own pockets, but is it also, there's obviously something in there, but is it maybe the education piece? Maybe they're not educated. Maybe they think this is great. High depreciation.
Yeah, that's
going to cost me $10 a week.
Yeah, that's right. Some of them are, I think the vast majority are well-meaning. They're just misinformed.
Okay, and that leads to, I guess, the misinformation out there.
Yeah, so on that very topic of being misled by professionals in the industry, I listened recently to a podcast about available land, and it's from someone who considers themselves an expert. In fact, they signed off the podcast with head of research, Australia's leading market forecaster.
How do you get that?
Yeah, I don't know. I'm just...
what number are you at?
Well, I'm only assistant to the regional manager. So, yeah, I don't know where they get that from. Maybe it's alphabetical order. Anyway, they gave some pretty bad advice regarding vacant land, and the way they conducted their research was appalling. It is what I would expect from a complete amateur. Certainly not what an expert researcher would do.
And I just want to let everyone realise how much effort you've gone to put this together, because I looked at it and I've gone, Jez, this must have taken you a long time while we're doing a lot of other things at the moment. It's great to see that you want to let everyone...
Well, these sort of insights come from hours, weeks, months. They don't come from like 10 minutes on a phone app or knocking up a few lines in Excel.
Do you want me to discuss the quotes? Do you want to step it through, or you want to do it?
Yeah, thanks.
Okay, so the quotes from their intro or...
Yeah, so this is not me. This is from their recording.
So the first one is, I'm sure you've heard this before, available land is terrible for capital growth. That somehow if an area has more available land, you should stay away and invest in an area without available land instead. But like some of the other myths that we've torn apart in previous episodes, today will be no different. I want to show you why this sentiment is not backed up by the data and could be hindering the success of your portfolio.
Yeah. Now, what's most alarming here is how this guy says he has torn apart myths when, in fact, he's just creating yet another one. And he even goes on to say he has used data to debunk the myth when really his misuse of data has created a new myth. So what I'm going to present next...
Examples. We've got some examples, don't we, that this individual has referenced. So I'll let you talk.
Yeah, so this is an example going on in his presentation of the sort of research which I believe is worthy of a complete amateur. And this is what causes investors to get misled. So what he's done, his first growth comparison he did was Campbelltown versus Newtown. This is in Sydney. So here's a little map of the southwest of Sydney. And you can see, Campbelltown, the very southwest. And he's also compared that to an inner area of Newtown, which they call inner west. Now, he pointed out that the growth of Campbelltown over the last 10 years has been 119%, while Newtown only had 95% growth. And he said these figures came from CoreLogic. Now, I calculated the growth of Sydney for the same period to be around about 136%. So the period of interest we're talking about is the last 10 years, I think ending 2023.
And that's a point in time, isn't it? And it's easy to pick that.
Single point in time can be a problem because eras come and go. Sometimes you can have outer areas outperform and sometimes the inner areas. So you need to try a few different points in time.
And do we know when this was or not? Like, was it from 2010 to 2020? Do we know?
It was ending 2023. So it would have been 2013 to December 2023.
So we've got another example, Glenwood.
Yeah, so Glenwood's to the northwest of Sydney CBD. It's that little triangle you can see there in the top left. The Sydney CBD is down to the bottom right. And actually, if we drill in, can you go to the next slide? Yeah, so there's a little bit closer view of where Glenwood is. It's nestled in amongst a lot of other suburbs. But 10 years ago, there was some vacant land to the northwest. Not to the east, south or southwest, but there was some vacant land. It hasn't really been near vacant land for a while now. So it's not what I would have classified as the stereotypical suburb that has been near to vacant land. But it doesn't really matter anyway because this whole argument is quite subjective. The assessment is quite subjective right from the get-go. Anyway, Glenwood's growth has been around 140% in the last 10 years, which is pretty much in line with Sydney's growth. So I don't know what the point was in picking it out. And by the way, he said that this suburb was selected at random. He also mentioned that apparently he lives there or used to live there. I couldn't quite make out. So I don't know how capable human beings are of picking things truly, genuinely at random. Since we all have biases, but he's saying that he picked these suburbs at random.
Maybe it's the dart method. You get the map out and throw the dart and maybe it's hit Glenwood.
Yeah, odd that he lived there. Okay. Anyway, in the next slide, so we've got a satellite image here of, this is Bendigo in Victoria. So he picked out the suburb, an outer suburb of Epsom, which is to the north, just in the view there, sort of chopped in half a little bit. So Epsom, according to CoreLogic, had 80% growth over the last 10 years. Now, I calculated the growth of Bendigo as a whole, not the inner suburb of Bendigo. This is the entire significant urban area, and it had roughly the same growth as Epsom. And he picked an inner suburb of Kennington. It's just to the southeast of the CBD. It had lower growth than the city as a whole of only 71%. Now, I don't know why he picked Kennington to be the inner suburb, since Kennington does actually border some vacant land to the south. I would have thought Bendigo Central would have been a better choice. North Bendigo or Ironbark. Ironbark's another one. In fact, in Bendigo, I could only find, out of about a dozen suburbs, there's really only about 3 that don't border vacant land. So probably not the best example, this city. But anyway, those 3 suburbs, is what he picked out. So Bendigo as a whole, Epsom and Kennington.
But they're all in the same significant urban area, is that right?
Yeah, that's another point. Like, why wouldn't they have very similar capital growths when it's all a fairly small area?
All right.
Anyway, seems like a peculiar random choice and highlights just how subjective this analysis is. Now, at this point in his podcast, he says something I thought was staggering, truly amazing. And I quote, "This is lots of data to feed into it, as well lots of sample sizes." So what he's trying to say there is he's looked at a lot of data right now. Just in those 10 minutes, he has looked at what he considers to be a large amount of data and come to the conclusion there's nothing wrong with vacant land. Now, if you had shown me calculations based on 500 suburbs, I would have said, whoa, why such a small sample size? That is way too small to be considered reliable. And I'd also pop in there, look, you should probably consider more than just one 10-year growth period. That's if you had analysed 500 suburbs. He hasn't even looked at 50. He's only looked at 5, and he's already saying this is a large amount of data. So I'm just, amazed at that. He goes on to pick another half dozen suburbs before wrapping it all up and finishes off claiming to be Australia's leading market forecaster. Yeah, I had to play that back a couple of times just to make sure I wasn't mishearing. He did say that he was Australia's leading market forecaster.
I had a quick look at the video and I noticed that he was on his phone or something? He did the market analysis on his phone?
He got all this data from a CoreLogic app and he was looking at it just on the fly, 10 minutes worth of research. Now, any research you can do in 10 minutes is not going to be research. What I'm going to show you, the research that I did took many hours. And I'm sure it wasn't 10 minutes for research we're going to hear about from others later on. Okay, so yeah, what makes his presentation really worrying is twofold. First of all, he's claiming to be busting a myth when he's actually creating one. And secondly, he's giving genuinely bad advice that could be very harmful for investors. Oversupply is a killer, and I have incurred personally myself an estimated $1 million opportunity cost from taking the advice of a fake expert. This is back in the day when I was a beginner, a noob, and I bought in an area which for 15 years had no growth.
And I've seen a lot of clients come through that I've sat down with and they've had existing properties and same thing, purchased brand new, and it's gone backwards.
Yeah, and oversupply is usually the big killer. It's one of the biggest risks for property investors, and it's pretty easy to avoid if you simply steer clear of vacant land. Actually, just before we go on, I just want to give a little bit of a background. So this guy he's the founder of a buyer's advocacy, buyer's agency, right? Now, they make their money by turnover, same as real estate agents. So if you have an objectionable client, someone who's looked at this property that you've put forward to them and say, oh, look, I don't like it, it's too close to vacant land, then that spoils your rate of turnover. It chews into your revenue. So I'm wondering, I'm not suggesting this, but I'm wondering whether this podcast was a bit of a PR stunt, a bit of marketing exercise to try and stop people from being so objectionable to improve his revenue. Now, if that is the case, I think that's disgusting. I actually don't think that is the case. I think it's a simple case. He's probably well-meaning, but he's just got no idea about data. He's got no idea about vacant land. He's not one of these sort of data people, even though his title is head of research. I don't know how you can be head of research and do such appalling research.
My frustration is they shouldn't be saying anything. Just keep your mouth shut in a polite way. You know what I mean? It's just so frustrating when I see this, and it's very common.
Yeah, the thing is, in this industry, I've noticed nobody's pure evil. You get good with bad. So some of the stuff that this guy publishes might be okay, but this is definitely terrible advice.
Well, how about we jump into your research, Jez?
All right, yeah. So we've seen an example of how not to research. Now I'm going to show you how I went about things. So this is what I did now, not the other guy. What we're seeing, that's the end of his stuff. This is my stuff. Now, admittedly, my research is not comprehensive. I only had time to look at things from one angle, and the angle that I chose was that of new supply as measured by increase in dwelling counts. So how can the number of houses in a suburb increase significantly in an already built up area? So the only way you can see large increases in the count of dwellings is in that image to the right there, where there's loads of vacant land available. Now, I just want to point out that having vacant land doesn't necessarily mean that it will be developed. It just means there's a risk of it being developed. So I did this research measuring just how bad things can get if the vacant land is developed. In other words, how risky is it?
And with these Greenfield estates or a lot of this land supply, could that be considered as population growth?
Well, as long as someone occupies it, then there's an
increase in
growth.
population, because if you start at zero and there's more land coming on, houses being built, the population growth is going to be significant year to year, isn't it?
That's right. But first of all, you've got to supply the houses. So you have a big oversupply first before you can have a high population growth. All right, so let's have a look at the first chart. All right, so this chart shows the relationship between dwelling growth and capital growth over a 10-year period. Now, you notice capital growth is shown up the left vertical y-axis. So the higher up the chart, the higher the capital growth. And dwelling growth is shown across the bottom horizontal x-axis. So the further to the right, the higher the growth in dwellings. In other words, the higher the new supply. Now, you'll see there are 10 dots on the chart. So each dot on the chart is a group of Australian suburbs. In fact, it's the combination of a suburb and a 10-year period. So they're grouped according to their 10-year dwelling growth. You'll see across the bottom horizontal x-axis there are 10 groups from 1 to 10. So each group represents a tenth of the entire data set, and that's why it's called a decile.
So for all the listeners out there on the bottom section there, like the dwelling growth decile, there's 10 sections. So what would an example of the first decile be? Very limited supply or growth in dwelling count. So pretty much no dwellings coming onto the market.
Yeah, if you want to just jump forward to the next slide, there's actually examples from decile 1.
We'll have a look at that shortly because we've got suburbs, but I guess from a numbers point of view, it might be like 0% growth.
Oh, right, yes. Yeah.
But if we go all the way to the end, to the highest decile, that's telling me that that's areas with a lot big increase in dwelling count.
Yeah, I saw some of the figures were over 200%.
Okay, so you could think of that as being massive, these Greenfield estates, houses going up.
Yeah, stereotypical Greenfield estates.
Okay.
Yeah, so now I didn't just look at the last 10 years. So I looked for any 10-year period in a data set from 1990 to the end of 2023. So that's 34 years. So it could be the 10-year period from January 1990 to January 2000, or it could be the 10-year period from February 1990 to February 2000, or from November 1993 to November 2003.
So in each of those deciles that we can see on the screen, that's capturing those suburbs plus all the 10-year periods. So we're not looking from 2013 to 2023. We're going from 1990 to 2000, 1991 to 2001. So that's a lot of data points.
It's even more than that. It's January 1990 to January 2000. It's February 1990 to February 2000. So there are literally hundreds of those 10-year periods in the 34-year data set multiplied by the thousands of suburbs Australia-wide, and you've got over 1 million observations.
How long did this take you to?
Well, I write a program to do all this, but it still took hours. Yeah. So a fair bit of effort went in. Okay. So looking at the green dot on the far left, that's sitting on the y-axis at about 5.5%. Now that's per annum growth over those 10 years. And so this is, as we've explained, this is typical for a built-up area. Yeah, over the last 34 years, any sort of 10-year period, you're looking around 5.5%. The green dot on the far right, or bottom right, that represents the growth of suburbs that had the highest increase in count of dwellings in any 10-year period over the last 34 years. And that green dotted line, well, that shows an approximation of the general trend there is between dwelling growth and capital growth. So the higher the dwelling growth, the lower the capital growth. You're looking at not just 5 observations, close to 1 million.
And also, like, what's classified as a greenfield estate? Because let's say you've got a suburb next to a greenfield estate that might only be releasing 100 blocks every year instead of thousands. Like, what's classified as greenfield?
Well, I don't think there's any threshold, any official number to it. So that's why we just want to, in that chart, show the relationship. The more dwelling growth there is, the lower the capital growth for the same period.
Yeah, I think my point is if there's like 20 blocks available in a suburb that's already built out.
Yeah, that's not a big increase. So let's say the suburb has 500 houses in it and then another 50 get added. Well, that's only 10% over 10 years, which is fairly nominal.
But I remember, I think I've mentioned before the Donnybrook north of Melbourne there, like just farmland and farmland. They had a post office, I remember that, and a little coffee shop, but that was about it. A lot of developers.
Yeah, you were asking for examples? All right, so these are 2 examples from decile 1. So this is low dwelling growth over a 10-year period. So these are from the last 10 years because the satellite imagery is showing how they currently are, not what they were like, say, 10 years ago. But you can see there the Brisbane Airport to the east of Nunda. That's the image on the left, and the Brisbane CBD is to its southwest. And the prominent feature of Seven Hills, the image on the right, is that industrial area to the northeast. So there are scattered bits of green that you can see in Seven Hills, but they're reserves or sporting fields, so yeah, they don't usually get built out. So that's examples from decile 1. If you have a look at the next slide, these are examples from decile 10. This is the complete opposite end of the spectrum. So South Ripley, it's about 40 kilometres to the southwest of the Brisbane CBD. Box Hill is about 50 kilometres from the Sydney CBD to the northwest. And those brown patches, that's the land that's been cleared in readiness to build houses. And both of these suburbs have already had a fair amount of building in recent years, and there's plenty of available land nearby for more development well into the future. All right, the next chart. So remember how I was talking about looking at multiple periods of time? I thought, what's the influence over a 15-year period? So I've charted both 15 and 20 years and added them to the original chart. And you can still see the same kind of inverse relationship between dwelling growth and capital growth. You have a look at the purple dotted line. This is for any 15-year period in that 34-year data set. And again, it shows growth is hampered by new supply. Interestingly, the yellow dotted line, it shows the relationship between dwelling growth and capital growth it starts to be lost over around about a 20-year period. So you can see there's almost no relationship because the line is mostly flat. So greenfield estates are not always greenfield estates. Eventually the land runs out. Those areas become built up after 20 years. As you can see, there's only a faint reminder of the past poor growth.
And as you mentioned before, like when you started out, you purchased a property, 15, 20 years, and it had not much growth at all.
Yeah. So you can have these nightmare scenarios where oversupply lasts for a long time.
I think in Tarneet, in Melbourne there, like West, like a lot of land and house packages, and they're like 200 square metres, 250, like small, like boxes, shoe boxes, where you can look at some of those surrounding areas that are already built out, get those bigger blocks. Like
600 square metres, that's right. Well, you think about it from a developer's perspective, the block is an expense to them. They're trying to minimise that. But as investors, we want to maximise the amount of dollars we allocate to the appreciating part of the investment, the land.
Well, they chop up those blocks, don't they? Make as much as they can
Try
from
to squeeze as many in as possible, yeah. Okay, so overall you can see from this chart, the analysis shows that vacant land is not a good thing for capital growth. And the chart shows that the negative impact is usually, it's more likely to be felt in the earlier years. Eventually, time covers over a multitude of ineptitude, but these pure greenfield estates are going to be a problem. Now, you'll notice that the 9th and 10th decile, where we're talking about capital growth less than, say, 3%, compared to almost everywhere else of around 5 to 6%. So we're talking about half the capital growth over a 10-year period. If it's a $500,000 property, then that's an opportunity cost of $250,000.
It hurts.
Yeah, so this is an important topic for investors.
All right, so now we're looking at what the distance from greenfield estates versus 10-year periods.
So the next question that an investor would probably want to know is how far away do I need to be safe? What distance from them? So what I did here was I grabbed all the worst suburbs from around the country. That's the ones from the top decile, so the top 10%. From the previous chart, right? That's the 10th decile. Then I calculated the capital growth of their surrounding suburbs over the same 10-year period, and then I grouped them again by their distance from the greenfield suburb. I'm calling it the greenfield estate suburb. So you can see over on the left side of the chart, the typical growth of a suburb only 1 kilometre away from a greenfield estate suburb is lower. Compare that to 10 kilometres away over on the right-hand side of the chart. That's the typical growth. So again, very large number of cases being analysed here, a lot more than just a dozen. And the further the suburb is away from the greenfield estate, well, the better the capital growth that it had. And you can sort of see from that dotted trend line that after about maybe 8, 9, 10 kilometres away, you're probably safe. All right. Now, this is just how I have analysed things. That's just from the perspective of increased growth in dwellings. But I've asked Luke Metcalf of Microburbs, founder of microburbs.com.au, if he could do some research on the topic, and I want to hear his opinion. Luke, you can hear us?
I can, yes. Loud and clear, Jeremy.
All right, you want to take us through the research that you conducted on this topic?
Yes, absolutely. And thank you very much for this opportunity to share some insights. I really enjoyed your analysis.
And we've also got Ken online with us too from Suburb Trends. Hi, Ken.
Sorry, Ken, probably should have introduced you there as well. Yeah.
I'll unmute myself. Hello.
Suburbtrends.com.au.
That's the one.
All righty, let's go for it. So, Luke.
All right. Yes, so I did kind of a similar analysis, but with some important differences. So I looked at, we have in our database 58 million listings from major listing sites. And so what I looked at is, see these examples here where you've got land being offered for sale on the listing site. So we counted them for every suburb over time. And this is over a very wide period of time. So we're looking 1990 to 2024. And similar to you guys, I'm not simply looking at comparing 1990 to 2024. We're looking at every period within there. So it's like 2000 to 2005, 2005 to 2009, etc. So it's really trying to look at all up from a really bird's eye point of view. What is the effect? So going across all markets, thousands of suburbs, and across time as well. So yes, there's way more houses, obviously, existing dwellings, but what kind of effect does this 2 million have? And the answer is quite large, actually, overall.
So we're moving over to your graph over here, Luke.
Yes, it needs some explaining. So I did this one fairly quickly. So this graph is looking at what the effect is of land sales on capital growth for other houses. So I'm not talking about what happens to the land. I'm talking about what happens to other properties that are nearby to that. So in this particular graph, in the same suburb. So on the left axis, you've got your effect on growth. So there's a baseline in the middle there, that line that's showing, that's just achieving what happened for the national average. So I'm controlling for the overall market conditions of the country. And as you go further and further up, that means that you're outperforming the market. So, and then on the x-axis, what you have is the proportion of sales that were land in the past 5 years. So it's looking back in time and counting all the times that there was a land sale. So on the left-hand side, you've got where it's negligible. So you can see that there is 1.5% extra growth all up from a bird's eye view where there are negligible land sales. So when less than 1 in 1,000 sales within the suburb in the past 5 years were for land without a dwelling on it. And then on the other end of the spectrum, as you go to the top, this is where at least 1 in 5 sales are for land. So that's a pretty extreme example of lots of new land being made available over the 5-year period. So that's 2% less growth than the national average. So if you're looking at a national average of 6%, that's down to 4%. You guys have already done the calculation on how big of an effect. This is hundreds of thousands of dollars effect on how much capital growth you're going to get over a 4-year period. So a point here is that these are annualized figures, so this compounds year after year. So that's pretty large. And beyond that, I wanted to know also, okay, that's one suburb, but you could have land released in one suburb. What happens to neighboring ones? So if you want to go to the next slide, the orange line is where it's within 7 kilometers. So similar to you guys, you looked at how it started to degrade over distance. I found 7 kilometers to be a pretty good one. So 7 kilometers, even more change. One thing to note is that I'm looking 4 years ahead, whereas you guys were looking 10 years ahead. So that can lead to different results. But we can see overall, like I can tell you in the data game, you want to have many analysts, good analysts that you respect, tell you the same thing overall. They're not going to tell you exactly the same thing because they'll have different approaches. But yeah, the broad trend is that in general, a large amount of land is bad news for capital growth. And for obvious reasons, there's pure economics, supply and demand. It gets more nuanced though if you go to the next slide.
So Luke, before we go on, so you can see on that right-hand side of that graph, the further right that you grow, so more land, the higher probability of negative growth below the national average.
Yes.
So
yes, I should have probably talked more to this slide. So yes,
no, that's okay. You mentioned it, but it's just like for everyone that's looking at it, really simplifying it. More land is just higher risk that we see.
And you know what I think is fascinating about this chart? The trend is more extreme for the 7 kilometres away rather than the suburb itself. So what I'm thinking, I'm picturing like a Greenfield estate, that's the blue curve, and the orange curve is the suburb surrounding it. That the extra supply has affected the surrounding suburbs more adversely than the Greenfield estate.
Yeah, so it may be that it's more reliable. Obviously, you have a wider distance. Kent will probably speak to SA3s. You're getting to that sort of size, and that is a powerful kind of size. It is adaptive to the particular area. Obviously, it doesn't worry about the particular ABS boundaries. But yes, so you see it actually grow in importance. So what we're talking about here is it's not just that suburb, but it's all the suburbs within 7 kilometers. So if you imagine a larger area all being converted, having land with having that greater effect. Whereas if you could imagine with the blue line, it could be like new land coming into that suburb, but maybe surrounding suburbs don't have new land from that. So it's like basically the takeout here is don't just look at what's going into the suburb. Look a 7 kilometer radius around. That's an even better metric for you to see how that influences capital growth. Now it does, I always like to look over time, and I like to break it down by geography as well. And you see something a bit more nuanced here. So this is looking specifically in cases where it's very low land sales, so under 5%, so fewer than 1 in 20 properties being sold as just land over the past 5-year period. And you can see it's a very reliable trend with near the capital city. So You can see every single year. So that for me is like automated algorithm grade insight there of like, wow, this thing really works. That doesn't mean, by the way, that over 150 kilometers land doesn't matter. I wouldn't draw that conclusion because I've seen other work that I did. It's probably worth us going out with later. There's actually a sweet spot. So you don't want too much or too little. Having a little bit of supply into towns seems to be okay, but we're not talking about the Greenfield estates that Jeremy was talking about before. We're looking at a dribbling of new land, having some growth when you get further out into regional Australia is not a bad thing. But yeah, it's really strong thing. It's not. Oh, there may be an argument also to say that a bit of new supply is a vote of confidence, and maybe it leads to a bit more amenity, but you certainly don't want a lot of it. And I think we've got a couple of I'll just talk a bit more to this one, let's say. Minimum at the worst year, it's like 1.5% better growth near the CBD, where there is very few land sales. So that is I think of that as really rock solid once you're going over wider periods. And this is growth in the next 4 years. So if you're wondering why it stops at 2019 in this graph, that's because we're looking 4 years into the future here. So so this is really based on up-to-date sales. It's just obviously you've got to wait some time for the properties to grow. And I've got a couple of examples here where in the following slides where you can see some powerful inverse correlations.
So before we jump ahead there, Luke, like that 150 kilometers, like that green line. So as an example, would it be like Sydney, like Wollongong is about what, maybe 100 kilometers away, maybe further, maybe Nowra. Is that the way, like how you'd sort of look at it, the distance?
Yeah. So Newcastle would be outside that 150. And so your satellite cities will often be within the 150 kilometers. And then as you go out 150 out, you're more into regional Australia. Obviously, there's big variation in the size of capitals, but as an overall thing, looking at distance to capital city, CBD, and this is every capital across the country. So this is all the suburbs over this period of time.
Okay, thanks. So moving on to the next graph.
Yeah, so Bulgara, you can see here that the orange line is the proportion of land sales within 7 kilometers in the past 5 years. So the higher the higher the graph for the orange line, the more land sales there were. And then the blue line is growth over the next 4 years subsequent. So that, again, this is why it doesn't go so far in terms of the blue line. You see how it stops there because we've got to wait 4 years to know where it's going to go. So what you can see, and I've seen this in a lot of these, you just see an inverse correlation. So you've got to wait for once the land stops being sold, then you start to see the 4-year growth recover. So here we're talking this extreme, like 20% land sales and more. And there's a large number of these examples. This is not a rare case. And if you look at the next slide, it's a similar story. So Geraldton, we've got 20% land sales, lots of supply being injected in the market. And as the land sales kick in, the growth declines. And you've got this, the land sale, it slows down, it keeps slowing down, and then you have this recovery. But still, look, it's below zero. So this is still underperforming the national average. So it's definitely land is definitely something to look at. Yeah, so moving on to the next slide, this is an example of a suburb that had massive land sales. So persistently 1 in 5 property sales worth of land over the past 5-year period, and that went on for years. And you had a collapse in the actual capital growth performance. So the orange line here, the higher that is, the higher the proportion of land sales there have been within 7 kilometers. And the blue line is capital growth. So that's on the right there, you can see it's getting down to 20%. So 20% underperformance relative to the national average. And you can see that when the land starts to decline in the past 5 years. So that's a rolling 5 years thing there. So we're seeing it slowly decline. Then we see this recovery in the growth. So over a 4-year period. And the reason we don't have the last 4 years of the blue line is because it's 4 years into the future. So there are a lot of graphs like this where you're seeing this inverse correlation between land supply, particularly when you're looking at these extremes, like 1 in 5 properties being land for sale. And if you move to the next slide, you see something quite similar.
Sorry, Luke, just to jump in there. So with the Bulgara example, so 2017, the supply was getting absorbed. And I think that you mentioned that that's when you can start seeing the prices are slightly picking up a little bit, but still doesn't look great. The hit that you would have taken early on if you're going through that accumulation phase.
Yeah, well, you'll still notice.
So 2017 to 2021, 2017 to 2021, you saw outperformance of the national average, but that only started to happen once the land stopped. The land sales, the proportion of land sales decreased. So you see that decline around 2016. So when that happened, you started to see this recovery, and it started to actually beat the national average.
There you go.
So because
example.
we're looking over 4-year periods, it might look like it recovered earlier, but it's actually the subsequent 4 years. So if you look at, say, 2015, we've got a 20% land sales, and then it was so if we're going to 2019, we're seeing a recovery there. So you see this inverse graph in lots of cases. And Geraldton is another example. So you had 1 in 5 properties being land sales in 2010, and it slowly declined, but you're having this underperformance for a long period, and as it came down, you started to see a recovery in the annualized growth, but still underperforming the national average. You see that 0 there. So you want the blue line to be in the top of the graph, and it just wasn't happening. So land was probably holding back Geraldton.
Yeah.
And yes, that's my analysis.
Excellent. That's really good, Luke. Thanks very much for that. Different perspective, but same sort of conclusion. Now, before we hear from you, Kent, I just need to apologise. First of all, I asked Luke if he could prepare something weeks ago. I started on my analysis weeks ago. Kent, we asked you just this morning if you could present something. So very sorry about the late notice, but just thought it would be good to hear from you too.
Yeah, great. Whilst you were talking, I pulled up my 10-year charts based on a statistical area 3. There's around 330 odd SA3s that I use to carve up Australia. There's a few more than that, but by and large, rather than using suburbs or local government areas, I use something called a statistical area 3 for my time series analysis. I find them statistically sound and they're less volatile. I quickly looked at Sydney inner Sydney houses. Now, obviously, there's an abundance of rentals, so the turnover is a bit lower, and there's abundance of units that throw inner Sydney out. But I tried to obviously land the market that was closest to the one that you mentioned. And that had a 10-year growth of $885,000 compared to Campbelltown's SA3. So Campbelltown, not only the suburb, but it's also an SA3 that encompasses several suburbs. It had a growth rate of $440,000. The percentages were different, obviously. We're talking 91% based on my data versus 116% for Campbelltown. So the issue there is we're measuring by percentages, and if you measure off a low base, which is often the case in many new estates. So I'm going to pick on one example. A lot of magazines publish these top growth area charts, and they're very dangerous because you grab a spreadsheet and by virtue of doing a sort by percentage you're measuring the volatile ones, you're measuring the wrong ones by virtue of where they land in most cases. There was a place called Fern Bay, just north of Newcastle, that dominated the charts for a couple of years. And it was born of the fact that the new estates were all selling at that time for 400,000, but the houses that we were comparing to a year earlier, or 2 years or 3 years earlier, were asbestos-ridden places that were selling for $50,000 and $60,000 along the highway. So you've really got to be careful about picking on suburbs. And thank you, Luke, for calling out the SA3. And I threw one out extra in there, Bendigo. So I only got 3 in there during that time. It had a growth rate over 10 years of $232,000, or 74%. They're my numbers at the SA3 level. So I think that's the first thing I'd like to call out. Then I want to lead into a few practical questions that somebody should ask a buyer's agent before they enter into things. So they probably first should ask, are you recommending this location or this property type because it's easier to buy? And more often than not, there's an abundance of available stock to select from. So it does make it easier to earn money. Now, you don't earn money as a buyer's agent unless you buy something. So that would be the first question. Are you suggesting this area because it's easier for you to acquire a property? That would be my first question. The second question I would ask, and this is from personal experience, is are you receiving any rebates or incentives from the developer? That's okay if you are, but you need to be open about that. That's probably the second. The other questions I'd probably ask is, with the Greenfield sites, what usually happens is the developer will drip feed that market. So it's not a natural organic marketplace for some time. So we've got a controlled supply, but we've also potentially got a number of grants going on. So there's for many years we've dealt with a lot of government grants impacting demand, and we've had a lot of control mechanisms from the land or the developer controlling supply. So the question then is, what happens when all of that goes away and it becomes a pure secondary market? And that is the stuff that concerned us in the mortgage insurance space. So if you look at some of the mortgage insurer risk postcodes, QBE seemed to be the dominant player, but back when I was in that game, the company back then was called G Mortgage Insurance. I think it's called Helia now. Anyway, they are often very concerned about house and land areas, because what often happens is an influx of people who have relatively high LVRs, high loans. They're all similar profile, similar demographic, and you won't have a very high percentage of fully owned properties, not for some time. So what often can happen is when the mortgage claims occur, they occur in one fell swoop. So if interest rates go up, the impact that has on that market is profound. If you're in an environment that we've already been in, you'll probably see that a lot of the markets that have been a little bit subdued have had a lot of supply, but they've been secondary markets and they've been impacted adversely by our interest rate rises of late. But we've had such limited supply and such high population growth that I would argue that most markets are not behaving like normal markets because of this absurd level of population growth. So that would be probably my other call out. The other question that might be a relevant question would be to maybe talk to some of the selling agents and ask, do you find any particular buyers agents have a propensity to pay over the odds for properties? And what's happening is a number of buyers agents are starting to build a bit of a reputation for being the one to call when you want to offload a property. So I think there are a number of questions. I don't know who you're talking about in this particular case, but I think there are some questions that need to be ask, especially of somebody who is putting all of their trust, $500, $600, $700 million worth of trust into somebody who may be talking or spruiking. So I don't know if they're talking the truth or spruiking. So that's probably the key points that I would raise.
Excellent. Thanks, Ken, for that. Yeah.
I might add a bit there, but Ken, you made a good point, because I've worked with clients in the past where they've held properties and they've gone to refinance and they're struggling because they need to have a lower loan balance or loan to value ratio. So I have seen that. So I guess that's a higher risk that you have to consider when you're building out your portfolio.
Mm.
And it'd be interesting too, like with the repays, do they need to be open with it? Like, let's say you go to a land and house package, like, do they say, oh, I'm getting 30 grand off this guy? Because that's a question you should be asking. What are you getting paid?
Yeah, how do you get paid?
How do you get paid?
Great question. Good general question.
All right, Jens, anything to add?
Yeah, I would just say, obviously, be careful about median prices as well. So if you have a whole lot of new homes built in an area, you don't necessarily... you might have quoted median prices over time that haven't taken into account that there is so much more value in the house than before. So if you have a suburb with, let's say, $300,000 lots on it, and then $500,000 homes get built on it, suddenly they would be reporting that there's this massive growth from 300,000 to 800,000. But that doesn't mean that you've actually achieved any growth in your property if you have an existing dwelling, or if you're the one who had to pay for putting the house in. So the house as a depreciating consumable good, as opposed to the land, which is the thing that is actually growing over time. So yeah, be very careful. In the analysis I gave there, I was actually looking at same property growth mostly. So to check, to ensure that you get around this median price problem. So you can have the majors report honestly what the median price is at 2 points in time, and in both cases it's accurate, but then it's wrong to think that actual growth happened between them because of the change in the housing stock, all this beautiful new homes.
Well, I had people come to me and they go, oh, this area is grown by this much. I saw it on the news, and it's land and house packages.
That's exactly the case,
That's it. Yeah. All right, guys, I appreciate your time, and until next time.
Yeah, thanks.
I appreciate it, guys.
Thank you very much.
Great effort.
Take care.
Sorry for the late notice, Kent.
That's all right.
And
thanks for the invite.
Apologies for the background noise too. There was a bit of rain where we are, so take care.
Thanks, guys.
All right, Jez, good wrap. So
that was excellent content, wasn't it?
So we're hoping, like, this was very in-depth, but we're hoping to get more like this, aren't we?
Well, I'm assuming people want more of this. If you do, please click like and let us know. And there is more like this. And if you subscribe, YouTube will let you know.
Yeah, so like, subscribe, share to the world. And until next time, see you in the next episode.